Hi there, my name's Alli Varnes, and I am very pleased to be the US-based expert in residence for UNE's Smart Region Incubator Program for 2020. I've only just moved back to the States after 10 years of living in Sydney, and I am delivering this presentation today as a re-recording of my initial workshop, which was Dealing with Investors Part 1, Managing the Entry. So today I'm just going to be delivering the first half of that presentation, mostly focused on your different investment options. So let's kick off. A little bit about me, just to give you some context as to why I'm delivering this presentation as part of the program. I have had my own startup. We were based in Sydney but operated nationally across Australia. Basically started the business because I was a person with a problem. I had a little bit of money and the entrepreneurial audacity to believe that I could solve that problem and help millions of people. So probably very similar to a lot of you watching this presentation today. I didn't start out with the intention of starting a business. I just came across an opportunity and thought, why not me? So started out as a journalist, worked as a consultant when I first moved to Australia over 10 years ago, and then found myself on the entrepreneurial path. So yada, yada, yada. Right now I am operating mainly as an advisor, a mentor, and a board member. I exited JobGetter, our business, in July of last year. So now I'm looking for my next big challenge. But over the course of that journey, I did raise over 2.7 million in total funding. That's an estimate, really. There's lots of little kind of bits and pieces, but the majority of that funding came from startup capital. So the initial money that me or my business partner and I put into the business, we reinvested in that business over the course of the 10 years that we had it through both loans and salary sacrifice, but that's another side of the story. We also raised about 25% of that funding from grants, a little bit from loans, and then majority was from investors. So I'm going to be kind of covering the gamut of the different investment options that you have at your fingertips to help fund your business in this first half of the session. And then in the second half, just to break it up into two shorter videos, I'm going to dive further into dealing with investors specifically, because I think that's primarily where you're going to A, find your funding, and B, where I get a lot of questions. So, and that's where a lot of my experience lies. So diving into the investment options that you have at your fingertips, the various options you have to consider are primarily fall into these categories. So your personal savings, external income, revenue, grants, loans, investors, crowdfunding, and I threw in backdoor listing because that is an option that we considered for quite a few years. So it's something that is an option, and I have seen others put that into play. So those are the different options I'm going to be covering, kind of doing a pro-con so that you can apply some thinking to your business, your scenario, your situation, so you can decide which options are best for you and where to put your time and your energy. Before I dive into the first option, I wanted to just put up a slide to say, first ask yourself, what kind of business do you want? Where do you want this business to go? Why are you in business? And if or when you want to exit. So I think it's very important to keep this frame of mind while evaluating the different options available to you in terms of funding, because it really will help you dictate which ones are best suited for you in your unique scenario, your unique business, because it's not one size fits all. Going after, say, angel funding versus going after grants is a very different kettle of fish for you and versus somebody else who's in business. So everybody watching this will have a different lens that they're going to look through these options with. And so I think it's important to keep these answers or these questions in mind, because your answers may change over your journey. I was in business for 10 years, and something that I somewhat wasn't conscious of throughout that was asking myself these questions all the time. So I think it can be very alluring to chase the unicorns, but is that really what you want or what you need? How much risk do you have an appetite for? Are you in business because you simply love it, or do you want an exit and move on to the next thing? Again, I don't think I really put enough thought into these questions in the beginning of my journey. And in my case, I rode the startup roller coaster with dreams of an exit that would put a large amount of money in my bank account. But I'll follow up on more of the back half of what happens when you're exiting your business in my workshop in June. So today, let's just dive into the options, and maybe once you've had some time to think, jot down your answers to those questions. So kicking off, personal savings, a big obvious one. This is part of bootstrapping. You are the investor. So I think it's very important for you to think of yourself in that context. Consider yourself your own angel investor. How much are you prepared to invest? Do you have family that needs to be part of that decision? Will you retain some savings to reinvest in your business later, like an angel investor might do? So are you going to put, say, just throwing arbitrary numbers out there, $10,000 in now, but reserve $10,000 in case you need to get further before either the revenue starts coming in or you need to go to market and raise money from outside investors? What if you don't reach the desired result? Are you prepared to lose the money that you're investing? So those are some of the questions that I think are important to consider when you're putting in your own money. Most investors, if you do go to market to raise external investment, they're going to expect that you've put some sort of skin in the game, but how much skin is entirely up to you and whoever else needs to be part of that decision. So pros and cons. Obviously, if you're putting in your own money, you're not diluting. You're not giving away any of your equity to somebody else. You don't have to answer to anybody else in that vein. So you maintain control. It does force you to be incredibly efficient with the money that you have because you can't just it's a finite amount of money, and if you don't reach the desired results that you're hoping to achieve and there's no more income coming in, then it could be game over. So you have to be very careful with the money that you have to spend it as efficiently and effectively as possible. And it also means no distraction. So you're not distracted by keeping other shareholders happy. You're not distracted by the process of fundraising or grant writing or applying for grants. You're not distracted by the legal, the legalities of raising money. So it can be a pro in that sense that you're not distracted. You're simply focused on, here's the money I have, here's what I need to achieve with that money, and just going full tilt to try to achieve that goal. The cons of just having your own personal savings, again, little obvious, it's limited. So unless you are very lucky to be very fortunate in the wealth department, I'm assuming a lot of you have a limited amount of your own money to invest in your business. So again, that can be limiting in terms of not just the amount of money, but the help that you have access to, the runway time to deliver on your goals and execute on those goals. So it can be quite constraining. If you the second big con is it's more personal risk. Obviously, if you're putting your own money in, are you putting yourself at risk of financial ruin? Are you putting yourself at risk of simply just losing out on all your savings and having to start from scratch? That'll be very personal to every one of you watching the presentation. So some people have more appetite than others, and it's important to kind of weigh that up in the beginning. So like I mentioned, consider yourself the investor. Go through these options and ask yourself these questions. Throw it around with either your co-founder if you have one, or your partner, or if you have a mentor that you can throw these ideas around or these questions around with. It's just important to make sure that you do think of yourself as an investor and look at this as an external investor would. So I'll just run through these very quickly again. How much are you prepared to invest? Do you need to rope other people in to help make that decision with you, or are you making that on your own? Are you going to retain some of your own personal savings to reinvest in the business later if you kick the goals that you're hoping to kick? Do you have or want the option to get any or all of it back? There's the option to say, I'm going to put $10,000 down into the business now, but as soon as we hit these revenue goals or this milestone, then I would like the option to draw back that money, but maintain my equity. You have a lot of those kind of options at your fingertips when especially you're starting out and you are the key decision maker and you aren't answering to other shareholders. And then what if you don't reach that desired result? Are you prepared to lose the money that you've invested? And that's a big one because there's a big chance of that happening. And obviously none of us being entrepreneurs want to think in that negative frame, but it is important to know that, that money that you otherwise might have put down for a house deposit might not be there in 5 years' time. And so it's important to just make those decisions carefully. External income. So again, part of bootstrapping, you might be starting up your business and still working your day job. You might try to juggle part-time business, part-time worker. For the first 2 years of my business, I worked as a consultant, and I also picked up weekend work in retail. And that was the first 2 years. I was terrified on the weekends that somebody I was meeting with during the week, trying to sell them on one of our packages, would walk into my store and realize that I was working behind the counter. Very rare chance that would happen, but there was still kind of that thought of, will they take me seriously? It's something I think a lot of people don't really talk about in the beginning, especially if you have to do what you have to do to supplement your income while your startup gets off the ground and you can't afford to pay yourself a salary. So if that's something that you can do, it can be very helpful because, again, it means no dilution. If you can fund yourself through external income while you're building your business, then you can maintain, keep reinvesting in the business and not draw out money that could go towards growth. So you're not diluting, you're maintaining control. And again, you're forcing yourself to be really efficient with the funds that you have available to you, similar to personal savings. But again, the cons would be it is limited. You can only work so many hours in the week and have access to so much in income. It is a major distraction. So you're juggling, in my case, I didn't have a young family at the time. I do now. So many of you might be juggling kids and partners and family responsibilities on top of starting up your business. And then if you also are trying to fund that your life, your family, and your business through external income, you've got a lot on your plate. So there's the question of whether or not you're able to put the time into your business that you need to get it off the ground. Again, it does make you very efficient with your time. Ideally very focused on the goals that you need to hit with the limited time that you have. So again, pros and cons. If it's for a short time, then ideal. But if it's, for 2 years, we got to the point where we hit the milestones we needed to hit to then go to the external market and raise money from external investors. And at that point, the money that we received from those investors gave us what we needed to go full-time on the business. And when you do go to market, investors are most likely going to want to see that there is a full-time commitment to making the business grow. Moving on, the next option you have is revenue. So this is the holy grail. Everybody wants to just build their business from the money that business earns. And it is part of bootstrapping. So you're not going external. You're not raising money from outside of the business. And again, it's the ideal because there's no dilution. Again, you're not raising money and carving up your equity and giving that out to new shareholders coming into the business. Again, you maintain control. And it's very efficient. Again, you only have a finite amount of revenue available to grow your business and to run that business. So if it forces you to be very efficient, and it really demands focus. So the cons, potentially limiting. Can you grow quickly enough to get high enough off the ground to get to where you need to be to get that business off the ground? or do what you need to do to be successful. Is it enough money to hire the staff you need, secure the contracts, buy materials, go to market, do marketing? Is it enough money to be successful, or are you going to kind of bounce around on the bottom of the and kind of jump back down and not give yourself enough capital to get high enough off the ground to really get going? It also requires early value. So can your business exist from day one with a revenue model, or do you have to reach an inflection point before you start charging people? For in my case, our business was a double-sided market. And the question we always had was, are we offering enough value to be able to charge people? And our answer to that question was no for the first few years, because we needed to have enough supply to meet demand. And we didn't have confidence in that double-sided market, that our user base was large enough to charge people to access them. So in that case, we looked at external investment to help fund the business till we could start charging people and earning revenue. So scalability is the third con that I've put against revenue. You might start with a less scalable business model in order to fund the early stage of your business, and you could get stuck in that model. For instance, you could have a consulting revenue stream that is soaking up a lot of the time that you have to build the business, which leaves you with less time to invest in a more scalable business model. So I think when I look back on our journey, I do wish we had thought of an alternative revenue source that could have helped us earn more revenue faster in the early days, so that we had more time to then build the more scalable side of the business, which was just SaaS-based software as a service, access to our user base. But in the early days, we really just focused on building both sides of our market as efficiently as possible. So pros and cons of revenue. It's ideal if you can get there. It's not always possible, and that's why a lot of people look for that external funding sources. The next best is really grants, free money, basically. Everybody always kind of refers to grants as free money. Definitely not free, because it takes a lot of time to access it, and not everybody always does. So in terms of pros, again, no dilution, maintain control, and the one that you don't really get from the previous investment options I've gone through is that big credibility boost that you get from getting a grant. We were very fortunate to get a number of grants throughout our startup journey, and every time we got one, it was a big PR move. All of a sudden we could say, received grant funding from the New South Wales state government, and you've got that tick of approval from the local or state or the federal government, or if it's a big corporate who's doling out that grant money, you can now align yourself with someone external to you that gives you that credibility boost. So again, it can be great not just for accessing funds that otherwise you wouldn't have had access to, but it also can help you in your sales pitch, in your next investment pitch, to have that tick of endorsement from receiving grant money. The cons, very time intensive, not just the application process, which is usually very intensive and can feel sometimes a bit overly taxing, because you can when you're going through these applications, often come across repetitive questions or seemingly insignificant questions. Sometimes they can really, it can seem out of touch. There is often grant applications that we would go through, and they would ask for 5-year, 7-year forecasts, and you can barely forecast the next 6 months. And so that can sometimes feel frustrating. Not necessarily that it wasn't warranted, but when you are a startup entrepreneur, possibly juggling a side hustle, a full-time job, family obligations, I'm just trying to make sure I've got product market fit, let alone forecast the next 5 years of sales revenue. So that can be a little bit frustrating. But not only is the application process time intensive, but so is the keeping abreast of the different grant opportunities that are available. So searching for those grants, analyzing those opportunities. Is it something we should apply for or not? Is it something that we're likely to receive or not? Because should I invest that time into applying if it's going to take months to find out whether or not we've got the funding, and is that a good use of my time right now when I'm already stretched so thin? And then not only that, but the review process, like I mentioned, it can take months to find out. And in our case, there were grants that we applied for where, halfway through applying or halfway through the review process, where you'd kind of get through the next stage, and then all of a sudden things would be put on hold. Things completely out of our control. There'd be a new budget being announced, and all of a sudden it was, all tools down until the budget's announced, or the government would change, and we'd have to again wait until after things settled to find out whether or not those grant opportunities were still in process. So we found the grant options to be very frustrating. I think in hindsight, I wish we had spent maybe a little bit less time keeping an eye out for grant opportunities. It can seem a no-brainer, free money, no dilution. It's excellent, but when it comes down to it, it's not free money. It does take quite a bit of time. And we did find that there are people out there who can help you with grant applications. I know that there's someone in the UNE SRI network who's excellent at doing this sort of work, and it is worthwhile getting those recommendations, because there are a number of people out there who do know quite a bit about what's available and can help you make the decision whether or not it is something you should invest time into. I think sometimes there are people who will, shortcut that process. And again, it's a question of whether or not they're the right people, and whether or not you can invest the money often that is required to get their help with those grant applications. So in our case, I think it's something I wish we hadn't invested as much time into, because not only is it time intensive, but it is a distraction. Keeping your eyes out for them. Are you bending your business model to fit the requirements? Sometimes that we did. We would pivot a little bit in terms of the feature roadmap that we had had set out to be able to answer some of the grant requirements. And then you have to ask yourself, are those changes worthwhile? Are they going to open up new revenue streams that are worthwhile? Or are you just creating a bit of a Frankenstein by kind of plugging in new features or new initiatives to be able to answer that grant demand, but really it's not beneficial in the long term for your business? The other, question is, are there requirements for that grant that you'll need to adhere to after you've secured the funding that is going to strain your business? There was one grant in particular that we received that was very intensive, required probably about half of our team's devoted time. And when it was all said and done, it didn't really open up any new revenue models for us. It did answer more of a community need, but we weren't then compensated for the time and the effort that we had to put in to be able to deliver on that. So I think it can be very tempting to mold yourself or your business to fit a grant opportunity because it's a feel good, especially a lot of those grants that are meant to help, parts of the community that need it. But whether or not that's good for your business is a big question you have to ask yourself. I also do warn, beware of sharks. It's sharky waters. Sometimes we came across people in the market who would, float around the startup circles who claim to be great grant experts who weren't really. Like I said, there are really excellent people out there, so getting a recommendation and going through a kind of trusted source to be connected with those people, talk to people that they've worked with, like you would an investor. You can kind of get references that way, and just make sure you're choosing the people you're working with carefully so that they don't waste your time and you don't waste money paying them to help you with grant applications. And my final point against grants is it can be fickle. So like I said, sometimes you can find that government changes, maybe the new government or new leader removes a grant program, the funding gets cut, they change the rules or decide to pull the funding back after they distributed it, which is also something that happened to us in our journey. We were receiving an incentive through a grant program, and that money was then requested back from us, which put us at a very precarious financial position. And then, grants that are announced and they accept applications, and then all of a sudden they disappear without even naming a winner. So it's kind of similar to doing an RFP or a request for proposal, and then all of a sudden they decide not to choose anybody. So again, if you're going to look at grant options, then just weigh up the pros and cons. Loans is my next investment option. So your own loans, are you going to keep reinvesting in your business? Your family and friends come into play here, convertible notes from investors possibly. And then if you are in a position, you can also go for a bank loan. Loans can lead to investors, so sometimes it's a way to kind of break the ice and prove yourself to a potential investor that you can deliver on milestones, repay a loan, and build that confidence with those individuals. In terms of pros and cons, it can be a significant cash injection that you need to boost the business and grow and scale. There's usually no immediate dilution if you accept loan money. You maintain control in that respect if there is no dilution, and you have an opportunity to establish that credibility and value to an external source. And it also demands focus because you need to be sure that you can repay the loan under the terms that you outline, and it can be just as time consuming. So again, pros and cons. The first con is that it is potentially time intensive. It can be almost as time consuming as it is to secure investment. So just being aware of that. It can lead to investment. So again, it could be a good use of time if that is where you're heading. And there tends to be a little bit more personal risk if the loaner wants a director's guarantee. So just weighing up again the pros and cons there. My next option, investors. So whether it's family or friends, angel investors, or venture capital funds, it's an option for you to go out and get investment from third parties. Pros and cons, it's a significant cash injection, which is great for growth and scaling. It gives you a big credibility boost, as much as I hate it. A lot of the media stuff, especially startup and business media, tend to use whether or not you've raised money as a big indicator as to whether or not you've got a successful business worth watching. Sanity check, it gives you, okay, these other people agree with me that I've got product market fit and I'm onto something good here. It gives you access to an expanded brain's trust. So all of a sudden you've got, I'm assuming, very smart people around you who are in your corner, and ideally can open up more of their network to help you. Maybe they know somebody that can help you get another sale or a better partner or a strategic partner. It also opens up opportunities for future investment. So ideally those people would have additional funds that if you were to kick some goals and meet your milestones and prove to them that your business is growing and scaling and worth reinvesting in, then they'll be there with another cash injection if you need it. In terms of the cons, obviously you do dilute, so you're giving away part of your equity. It can be a big distraction. That is something that we always were very aware of, that if we were going to go to market and try to raise another investment round, that it was going to be distracting from just building the business. Again, time intensive. At one point, we spent almost 12 months securing investment, and that was the longest that we ever spent. But there was also the time weighing up whether or not we were going to. If you added up all of the conversations that we had about raising money, it was a significant part of our journey. So the distraction cost is the opportunity cost. What aren't you doing if you're out there having, the 1,000 cups of coffee or the 100 cups of coffee that they say you have to have before you are able to raise money? And is your time better spent getting on the sales road or trying to build your community, whatever else that you need to do to build your business? Time intensive wise, it's not just the it's mainly seeking out and filtering and securing those investors. And then after you've raised money, it's also managing your investor communication and those relationships. So it becomes, a good part of your job. If I were to estimate, I think we probably spend at least 25% of our jobs managing investors and seeking out investment. And if I wish we hadn't had to do that as much as we did, looking backwards. I do also say beware of time wasters. So not just in the search for investors, but after they invest. Some investors that you bring on board can be incredibly needy, and that's not always obvious when you're interviewing them in terms of whether or not they're going to join your business. Some are really want to add a lot of their own input and they want updates. So it's just being conscious of that when you do weigh up whether getting external investment is the right thing for you. Just be aware that you are bringing people in who are going to expect communication from you. It also adds a lot of pressure. So it's not just you anymore. Now you're working to make your investment, your investors' investment worthwhile too. So it can add pressure for you to build bigger, faster, to maybe go global when you could have been better off staying smaller, growing more steadily, and exiting for less, but walking away with more personally. So I think weighing that up, you can also feel a little bit of pressure to sell when you might just want a legacy business. So again, you have to go back to those original questions that I laid out in the beginning of today's video to go, is this right for you? Do you want to go global? Do you want to build big and fast? If it's just you, then you could sell for a smaller amount and walk away and start the next thing, or you could just stay in your business for longer. So thinking that through. There is also the risk of too much too soon or not enough. So in that, I mean, I've seen startups who have raised almost too much money too quickly, and then it disappears. It's almost like you've just hit the jackpot and you don't quite know what to do with it. You had a plan, but all of a sudden it's like, yeah, let's hire that guy and we'll pay him the salary he's demanding, or let's, spend hundreds of thousands on a marketing campaign. You can sometimes get this windfall, and it's like you become Oprah and you go, you get a raise and you get a raise, and I'm going to take money off the table and let's do this marketing campaign. And I've seen startups kind of raise big amounts and then fail not that long afterwards. So there is that risk, and then there's the risk of not enough. So if you had the goal of raising, say, $1 million and you only raise 500,000, are you actually able to deliver on the goals that you promised at 500,000, or are you just taking what you can get and setting yourself up to fail and not achieving what you set out to with the money that you're raising? So again, it's just weighing those up. The next option you have is crowdfunding. So there are platforms for Australian crowdfunding. It's relatively new in Australia still. You can look up Possible and Birchal. Again, with this, there's a lot of validation and you gain visibility through crowdfunding. Pros and cons: significant cash injection. You can usually offer a reward instead of equity. If you have like an actual physical product, it can be really interesting because people will get behind it. And then you can say, here's my product at 25% of what I'm actually going to be retailing it for. So it's a way to get early sales and build that community. It gives you that credibility boost by having more people in your corner. And again, it's another early sanity check. So in terms of rewards and equity, it can be product or a service. It could be an equity interest. It could be a loan that gets repaid. Or are the funds simply a donation because people are supporting you? In terms of cons, possible dilution if you are giving away equity. Again, distraction. I've seen businesses that have tried crowdfunding spend a lot of time. It's basically all hands on deck when you're putting together a crowdfunding campaign. Unlike raising a round of money through investors, a successful crowdfunding campaign is it usually involves a big PR and marketing element. And what a lot of people underestimate is the communication strategy that goes along with it. So it's common for a crowdfunding campaign, to launch and then receive hundreds, if not thousands, of questions, emails, comments about the campaign itself, the rewards that people are going to get, and the end product. So again, it can be a big distraction. And it can be a lot of work for no reward if you don't reach your funding goal. And I'll be honest, I haven't seen that many successful crowdfunding campaigns in Australia yet. So if you get it right, you're set up for success. But if you get it wrong, it's a lot of effort for no reward. If you want to go for another type of investment, investors may look at your crowdfunding failure as a sign that your product isn't investable. So again, just weighing up how likely success is, whether or not you can deliver on a successful campaign, and what that might mean for you and your business. The truth is that a lot of campaigns fail. They fail to hit their financial targets. And I just recently looked up, as part of this presentation, Kickstarter's success rate sits at around 37%. So that means just about 1 out of every 3 projects actually succeeds. So again, one of your options, weigh that option carefully. The final one that I'm going to touch on before I end this first part of this workshop is backdoor listings. So a backdoor listing is an avenue for private companies to go public on a stock exchange without doing an IPO, or an initial public offering. So as a startup or an early stage company, it's most likely going to involve you merging with a public company, or even acquiring it if you do a raise pre-IPO. So say a small private firm wants to go public, but it just doesn't have the resources to do so. It may decide to buy out an already publicly traded company, or what's referred to as a shell, to meet the requirements. So a backdoor listing is not as expensive as an IPO, but it is still expensive. It also puts you on the path of becoming a public company, which comes with annual fees and increased costs and a lot more reporting requirements, a lot more scrutiny. So I've seen a lot of startups who have not been successful in raising capital required from investors or VCs that then go for a backdoor listing. Some investment banks seek out startups to matchmake with a listed company. We were courted by a handful over the years, and it was honestly just a big distraction for us. We saw a good friend of ours conduct a successful backdoor listing, and she's, arguably, I don't know if it's been ultimately a good thing or a bad thing, because we see that she's constantly being shredded in the press by her shareholders. So she, it was a way for her to get the money that the business needed to continue to grow. And but whether or not it was the best move is still questionable. So pros and cons: big cash injection can give you a big credibility boost. People love to see, oh, now you're on the stock exchange, you're a publicly listed company. It gives your shareholders, if you do have shareholders, a liquidity event, not for you as a founder, but for your shareholders, if you want to clean up the share registry and people want to pull their money out, then that gives them an opportunity to do that. Cons: you dilute, you're likely to lose control. It can be a major distraction, extremely time intensive. It can be very risky, because all of a sudden the public market's now dictating what your share price is, instead of a negotiation between you and your shareholders or your potential shareholders, and it adds a huge amount of pressure. I don't want to call it necessarily a Hail Mary, but I think that's how I've seen it work for some. It's kind of, I can't raise money from any other source, so this is my only option to get the money I need to continue to grow. And so it's kind of like, it's either go big or go home. So it is an option that's available to you. So those are the options I wanted to just cover, pros and cons. Again, go back to those questions I posed at the beginning of the video, and weigh up these options for you and your unique business and scenario. Feel free to connect with me. I've got my email up on the screen, available through LinkedIn. I'm based in the US on the East Coast, but always happy to jump on a Zoom call and help throw ideas around, opportunities around with you. And that's it for this video. In the next one, I'm going to deep dive into investors specifically and how to connect, what you need to do. And so join me for that video next. Thank you.